Welcome, dear students. Today we will delve into one of the most essential building blocks of microeconomic analysis, the theory of cost and production. This topic lies at the heart of how firms operate, make decisions, and respond to change in market conditions. In this lecture, we will explore how firms combine inputs to produce outputs, how they incur and manage cost in the short run and long run, and how these costs influencing prices or pricing, profitability, and market supply. You will learn the distinctions between fixed and variable cost, average and marginal cost, and the role of economies of scale in shaping firm behavior. Understanding production and cost theory is crucial not only for economists but also for everyone interested in business, policymaking, or entrepreneurship. Let us begin our journey into the world where economics meets real business decision. I'm Dr. Maida Mustafa Sadiq, Associate Professor in Applied Economics. Today, in this slide, we will explore how firms transform inputs into outputs and make decisions about resource use. And as I have mentioned, this is crucial for understanding how business operates, reduce cost, and respond to change in the economy. So what is production? Production is a process by which inputs such as capital or machinery, tools, buildings, labor or workers, natural resources or land and equipments are transformed into outputs, meaning the goods and services we consume every day. For example, a bakery uses flour, ovens, bakers, and electricity, which are inputs to produce bread and cakes, which are outputs. What do we mean by efficiency in production? Managers are always focused on using inputs efficiently. There are two main types of efficiency we need to understand: technical efficiency and economic efficiency. By technical efficiency, we mean a firm is technically efficient when it uses the least amount of inputs to produce a given level of output. So it's about minimizing waste. Example, if one factory uses 5 workers to produce 100 units, while another uses 3 workers to produce the same units, the second is more technically efficient. Economic efficiency. A firm is economically efficient when it produces a given output at the lowest possible cost, considering input prices. So it is not just about using fewer resources, but using the right combination of resources at the best cost. Example, a firm might use a more expensive machine that replaces 3 workers, but saves money overall. That is economic efficiency. Let us also explore what do we mean by short-run versus long-run production function. In economics, time matters when analyzing production. So, short-run production function. In the short run, at least one input is fixed, usually capital, like machinery or buildings. Firm can only adjust variable inputs such as labor or raw materials. The short-run production function shows the maximum output a firm can produce with a given amount of fixed and variable inputs. Example, a printing company has 3 printers, fixed, but it can hire more workers, variable. So output increases only by hiring more labor not by buying more printers. Long run production function. In the long run, all inputs are variable. The firm can change everything: labor, capital, equipment, land. The long run production function shows the maximum output a firm can achieve when it has fully flexible to adjust all inputs. Example, a car manufacturer might decide to build a new factory, buy more machines, and hire more engineers because nothing is fixed in the long run. Understanding the difference between short run and long run helps manager to plan for expansion, business expansion, decide when to invest in new equipment, minimize production costs, and respond to changes in demand or technology. So in summary, feature of the short run is fixed inputs. At least one variable is at least one input is fixed, while in the long run all inputs are variables. Some of the most important concepts in production theory is total product, marginal product, and average product. These concepts help us understand how output responds when we add more of a variable input like labor, while keeping other inputs fixed, especially in the short run. Total product, or TP, is the total quantity of output produced by a firm using a given amount of inputs over a specific period of time. Example, imagine a bakery using one oven which is fixed and increasing the number of workers. With one worker, they produce 10 cakes. With two workers, they produce 25 cakes. So with three workers, they produce 40 cakes. So total product increases as more labor is added up to a point. The total product curve is typically S-shaped. Initially, it increases at an increasing rate due to better specialization. Then it increases at a decreasing rate due to diminishing returns. Eventually, it may decline if too many workers crowd the space, which is negative returns. The second concept is marginal product. Marginal product is additional output produced when one more unit of a variable input is added, keeping all other inputs constant. The formula says that marginal product for product X equals delta T total product divided by delta Q, and Q here represent the inputs. Average product. Marginal product rises initially due to teamwork and efficiency. Then marginal product peaks and declines, law of diminishing margin returns. Marginal product can become negative if too many workers reduce productivity. Average product. Average product is the output per unit of input, and it equals total product divided by Q, where Q stands for the quantities of inputs used. When marginal product is larger than average product is rising. When marginal product is less than average product is falling. When marginal product equal average product reach its maximum. These three concepts help business decide how many workers to hire, when to stop expanding, and how to plan for efficient production. Now, in this slide, we are going to explore foundational concepts also in production theory. So let us ask simple questions. How do business turn inputs like labor and capital into the goods and services we consume? That is exactly what the production function helps us to understand. The production function describes the technical relationship between inputs or resources and outputs. In simpler terms, it shows how much output a firm can produce using a given set of inputs. Imagine a bakery that produces bread. Our inputs consist of 3 workers, an oven, and flour. So the output could be 300 loaves of bread per day. If a bakery hires 1 more worker and output increases to 350 loaves, the production function tells us how the change in input affects the quantity of output. So the production function help us to understand efficiency, productivity, decision making, and cost analysis. So it's a map showing how inputs turn into output. It's key for understanding firm behavior, efficiency, and decision making. It varies between the short run, some fixed outputs, and long run, all inputs variable. And it helps manager decides how much to produce, what combination of inputs to use, and how to minimize cost. Let us look to this table where we have the number of workers, output per hour, marginal product of labor, cost of factory, cost of workers, and total cost of inputs. So we observe that the number of workers is increasing from 0 to 1 to 2 to 3, 4, and 5, where output increases with the increase of the number of workers from 0 to 50 to 90 to 100, 20, 140, 150. If we have to calculate the marginal product of labor, it will be 50 minus 0 divided by 1 minus 0, so it is 50. 90 minus 50 divided by 2 minus 1, it is 40. 120 minus 90 divided by 3 minus 2, and so on. So you observe that the marginal product of labor is always declining and diminishing. The price of a factory is 30. So since it's fixed, it will be fixed at all factors of production. This is the total cost of factory, while the cost of workers is changing, it is variable, and the cost of factory is fixed. So number 4 is a fixed cost, and number 5 is the variable cost. The fixed cost remains fixed at all levels of production, and the variable cost increases with the increase in the output from 0 up to 50. If we have to find out the total cost of inputs, we will add up the fixed cost plus the variable cost. So this 30 plus 0 equals 30, 30 plus 10 equals 40 is the last column, 30 plus 20 equals 50, and the 30 plus 30 equals 60, 30 plus 40 equals 70, and 30 plus 50 equals 80. And graphically, we can represent this using the production or total production, where we put the numbers of workers hired or the inputs on the horizontal axis and the output or total production on the vertical axis. So we plot the previous table data into this graph, and then we end up with the red line, which represent the total production. So the marginal product is declining as input quantity increases, as we have seen in the previous. Let us come let us discuss what are costs and how do we relate cost, revenue, and profit in economic decision making. In economics, costs are defined as the market value of the inputs a firm uses in production. That means every resource the firm uses, whether it's labor, raw materials, machinery, or even the time of the entrepreneur, has a value. The cost of production is the sum of the values of all these inputs. So, what is total revenue? Let us talk about total revenue. Total revenue is the amount of money a firm receives from selling its output, its products or services. So it's calculated as total revenue equal price multiplied by quantity sold. Example, Aisha sandwich business, and each sandwich cost her $50 to make. She sells each sandwich for $120, so she sells 1,500 sandwiches. The total revenue will be equal to selling price multiplied by quantity sold, which is 120 multiplied by 1 multiplied by 500, which is equal $180,000. So Aisha earns $180,000 from her sandwich sales. But remember, this is not her profit. She still had to spend money to make those sandwiches. So profit will be equal to total revenue minus total cost. If Aisha made 1,500 sandwiches and each one cost $50 to make, and its total cost equal 50 multiplied by 1,500, it will be equal 75,000. So total cost equals $75,000, and total revenue is $180,000. So our the profits will be equal $105,000. Let us now clarify the distinction between economic cost versus accounting cost. Accounting cost is the actual monetary expenses a firm incurs when it produces goods and services. It includes things like salaries and wages paid to workers, rent for the building, utility bills, raw materials, maintenance, depreciation of machines. In short, accounting cost equal fixed cost plus variable cost. So what is economic cost? Economists look at cost more broadly. In addition to the explicit or monetary cost, we also consider implicit cost, especially opportunity cost. So opportunity cost is the value of the next best alternative foregone when a decision is made. For example, if an entrepreneur uses her own building for the business, she gives up the rent she could have earned by leasing it out. If she invests her own money, she gives up the interest of returns she could have earned elsewhere. So the formula becomes economic cost equal fixed cost plus variable cost plus opportunity cost. And this suggests that the resources could be better used elsewhere. Accounting cost, economic cost includes explicit plus implicit cost. Understanding the difference between accounting and economic cost helps business make smarter long-term decisions, not just about what they have spent, but also about what they are sacrificing. What is profit? At most basic level, total profit equal total revenue minus total cost. But what counts as a cost depends on whether we are talking about accounting or economic profit. Accounting profit is the profit reported in financial statements and what most business managers and accounting track. So accounting profit equal total revenue minus explicit cost, where explicit cost may include salaries, rent, raw materials, utilities, wages, or interest on loans. These are the actual payments a firm makes to others in the course of running the business. If a firm earns $100,000 in revenue and pays $7,000 in explicit cost, the accounting profit is 100,000 minus 70,000 equals $30,000. Economic profit equal total revenue minus explicit cost plus implicit cost, where implicit cost, or also called opportunity cost, refers to the income the owner could have earned elsewhere. Example, working a job or investing capital elsewhere. Forgone rent if the owner uses their own building for the business. Forgone interest from using personal saving. So if the firm had 10,000 in implicit cost, then economic profit equal 100,000 minus 70,000 plus 10,000 equal $20,000. Accounting profit shows how much money you had made on paper, while economic profit shows whether your business decision is the best use of your resources. Understanding this distinction helps firms make smart, forward-looking decisions. In this part of our lecture, we focus on understanding the cost of production that every firm faces when producing goods or services. Fixed costs are expenses that do not change with the level of output. Even if the firm produces nothing, still the fixed cost exists. Examples are rent on factory buildings, salaries of permanent staff, insurance premiums, depreciation on machinery. Whether a firm produces 0 units or 10,000 units, fixed costs remain fixed. Variable costs are costs that increase or decrease as output changes. They are directly tied to the level of production. Examples: raw materials, wages for hourly workers, electricity used in production, packaging. The more a firm produces, the higher the variable cost. Average total cost, average fixed cost. Average fixed cost equal fixed cost divided by Q, where average total cost equal total cost divided by total quantity. uh, of inputs. Marginal cost is a change in total cost divided by the change in total of the quantities of inputs, while average variable cost equal variable cost divided by the quantity of inputs. Let us break down the provided cost data table step by step to explain the concepts of total cost, fixed cost, variable cost, average fixed cost, average variable cost, average total cost, and marginal cost. This explanation is tailored for the students who are non-economists. The table shows cost associated with different levels of output, and the quantity is per hour for a hypothetical firm. Let us take the quantity and then move the quantity range from 0 up to 10, and the total cost from 3 to 330, 380, 450 up to 15 units. $15, while the fixed cost remains fixed at all levels of output. The variable cost changes with the level of quantity, and the total cost is obtained by adding up the variable cost plus fixed cost at each level of output. The average fixed cost is obtained by dividing each fixed cost by the quantity per hour that appears in this table. Average variable cost also is obtained by dividing variable cost by the output at each level of quantities used in the production. Marginal cost is obtained by the change of total cost divided by the change of inputs. For example, the change from 3 to 3 and 3.30 is 0.30, and the change in quantity is 1. So if you divided 0.30 by 1, you will get 0.30. Thanks, my students, for listening. I hope that